Before the year ends, there are several moves you can make that can save you thousands in taxes. The problem is many small business owners wait until tax season, and by then, it is too late. Some deductions only count if you act before December 31st. In this video, I will walk you through 5 year-end tax moves that are simple, practical, and incredibly effective for reducing your 2025 tax bill. Move number one is locking in year-end deductions. This is one of the easiest ways to immediately lower your taxable income for the current year. Most small business owners use what is called the cash method of accounting. That means the IRS only lets you deduct an expense in the year you actually pay it. Not when you incur it, not when you receive an invoice, but when you physically make the payment. This is why the timing matters. If you pay an expense on December 31st, you will receive the deduction on your upcoming tax return. But if you wait until January 1st, even by one day, the deduction shifts into next year. This can impact not only your taxes, but also your estimated payments, your cash flow planning, and even your eligibility for certain credits. Taking action before December 31st is essentially pulling deductions into the current year. This helps reduce your taxable income for the 2025 filing season instead of delaying those savings until 2026. Here are clear, actionable examples that almost every small business owner can apply. If you use software like QuickBooks, Canva, Adobe Creative Cloud, Shopify, Calendly, or other business tools, paying for the full year up front in December means the entire amount becomes a deduction for this year. So instead of spreading the cost over 12 months, you get the full write off on your next return. If you regularly buy supplies like printer ink, labels, polymailers, bubble wrap, or other packaging materials, stocking up in December accelerates a deduction you would have taken anyway. This is especially helpful if you had higher income this year and want to offset some of it. Many insurance providers allow prepayment of several months of coverage. If this is an expense you plan to pay no matter what, paying before December 31st pulls it into the current tax year. And if you owe contractors, virtual assistants, editors, designers, or marketing specialists money, paying those invoices now means you deduct them now. The same applies to professional fees like bookkeeping cleanup, year-end financial reviews, or even hiring a CPA. Everything here is about timing. These are not extra expenses. They are strategic early payments that shift the tax benefit into the current year while still supporting your business. Move number two is understanding Section 179 and bonus depreciation before you buy equipment or technology. These rules are incredibly powerful because they allow you to expense the cost of certain assets immediately instead of spreading the deduction over several years. The biggest misconception is that you can just buy something in December and automatically deduct it this year. That is not true. It must be placed in service. That means it must be usable for business. You must have it in your possession, set up, and ready to go. Simply placing an order in December does not qualify. Here is why the December 31st cutoff matters. If the equipment is placed in service before year end, you can take a deduction now, reducing your upcoming tax bill. But if you wait until January, that deduction moves into next year. In a high income year, accelerating the deduction can be extremely valuable. In a lower income year, delaying the deduction may actually be smarter. This is why year end purchases require planning. Do not buy equipment just to get a write off. Buy things that directly support your business and make sure you understand the tax impact of placing them in service before year end. Let's walk through some examples. First is a laptop. If you buy a $1,500 laptop on December 20th and immediately use it for editing client videos, running bookkeeping software, or building client proposals, it is placed in service this year. Section 179 may allow you to deduct the entire cost on your upcoming tax return. Next is a contractor purchasing new tools. If a contractor buys an $8,000 tool set and begins using it for paid work that same week, it qualifies for accelerated depreciation. The entire cost may be deductible this year through Section 179 or bonus depreciation, depending on your broader tax situation. Then there is the business vehicle example. If you purchase an SUV that weighs more than 6,000 pounds and business use exceeds 50%, you may qualify for a very large deduction in the first year. The timing is critical here. If the vehicle is not placed in service before December 31st, you lose the ability to take the deduction this year. That means the difference of an entire year of tax savings. These examples show why understanding the placed in service rule is essential. The deduction only counts in the year you start using the item, not the year you paid for it. If you need more details and catches on these rule, check out my other video I've linked in the card above or description below. Move number 3 is maximizing your retirement contributions. And this is truly one of the most powerful tax strategies available to small business owners. Contributing to a tax-deferred retirement account reduces your taxable income for the year, which means you keep more of what you earned. But here is what many business owners do not realize. The timing rules are different depending on the type of retirement plan. Some plans require that you set them up and make certain elections by December 31st. Other plans allow you to make contributions up until your tax filing deadline. Taking action before year end helps you secure the option to contribute later, even if you are not ready to fund it today. For example, a solo 401k must be established by December 31st for you to make employee contributions for the year. If you miss that deadline, the opportunity is gone. On the other hand, a SEP IRA gives you more flexibility because you can fund it all the way up until your tax return is filed. This is why planning in December is so important. You want to open the right accounts, make the necessary elections, and position yourself to take the deduction when you file your return. Waiting until January can limit your options and reduce how much you are allowed to contribute. The earlier you understand the rules, the more tax savings you unlock. Let's break down actual examples so you can see how retirement contributions impact your taxes. Start with the solo 401k. If you operate an S corporation and you pay yourself $50,000 in wages, you may be able to contribute up to $23,000 as an employee deferral. On top of that, your business can contribute an employer match. This combination often allows small business owners to save more than they can with any other retirement plan. Again, the plan must be opened by December 31st. You do not have to fund every dollar right away, but you must create the plan before year end, or the opportunity disappears. Next is the SEP IRA. This is popular among sole proprietors because it is simple and flexible. If your business profits are $100,000, you might be eligible to contribute roughly $20,000. The advantage of the SEP is that you can make the contribution up until your tax filing deadline. However, if you want the deduction to lower this year's taxes, you still need to plan for it in your year-end review. Many business owners forget and miss the chance to set aside money for retirement. Then you have the traditional IRA. While the limit is smaller, up to $7,000, it is still valuable for reducing taxable income, as long as you meet the eligibility rules based on your income and whether you are covered by another retirement plan. This can be a great option for brand new business owners who are just getting started. Move number 4 is cleaning up your bookkeeping before year end. This is one of the most overlooked steps, yet it sets the foundation for everything that follows. When your books are accurate going into January, your tax return becomes faster, cheaper, and far less stressful. Reconciling accounts now allows you to catch errors while the transactions are still fresh. That means fewer mistakes, fewer missing receipts, and far fewer adjustments when your CPA prepares your return. This also ties directly into the IRS matching system. Payment platforms like PayPal, Stripe, Venmo, Etsy, and Square will be issuing 1099-K forms more frequently as the new rules take effect. If your books do not match what the IRS receives, that mismatch can trigger an automated notice. Cleaning things up now prevents those issues later. What you do in December determines how smooth your entire tax season will be. Once January arrives, you no longer have the opportunity to rewrite the prior year's financial records. That is why this step is so important. Move number 5 is reviewing your estimated taxes before the final payment is due on January 15th. Many small business owners assume their estimated payments are fine, but income often changes during the year. If you earned more than expected, you may owe additional taxes. If you earned less, you may be able to reduce your final payment. The IRS charges penalties when taxpayers underpay throughout the year. These penalties are not huge, but they are unnecessary and very avoidable. Adjusting your final estimated tax payment ensures you stay penalty-free. And here's the key timing detail. The payment you make on January 15th still counts toward the current tax year. After that date, Any payment applies to next year. So if you know you will owe more for the current year, January 15th is your final chance to correct it. Now, here's the good news. The IRS gives you a simple way to avoid almost all underpayment penalties. It is called the Safe Harbor Rule. You avoid penalties as long as you pay either 100% of your total tax from last year or 110% if your prior year income was above 150,000. Another option is to pay 90% of what you actually owe for this year. If you meet any of these safe harbor thresholds, the IRS will not penalize you. Let me show you exactly what happens if you wait until April 15th to make up your estimated tax shortfall. If your estimated tax payment was short by $6,000, and this was more than 10% of your total tax, the IRS charges two things: an underpayment penalty and interest. With current rates, the penalty comes out to about $120 for 3 months, and interest adds roughly another $120. So, by paying late, you end up spending about $240 more than you needed to. But if you make your true up payment by January 15th, you avoid all of those unnecessary costs entirely. Before we wrap up, here's a bonus move that can have a long term impact on your taxes. Year end is the perfect time to evaluate whether your current business entity structure still fits your goals. Maybe you started as a simple sole proprietor or single member LLC, and now your profit has grown. This is the right moment to take a step back and see whether an S corporation election could save you money next year. For many small businesses, especially once profit reaches $60,000 or more, electing S corporation status can reduce self employment taxes. However, it also comes with payroll requirements, reasonable compensation rules, bookkeeping expectations, and state level differences. This decision should be thoughtful, not rushed. A key timing detail is the S corporation election deadline. To have S Corp status apply for next year, you must generally file Form 2553 by March 15th. But waiting until March is rarely ideal. If you decide in December or January, you can set up payroll correctly, plan your salary, update your bookkeeping structure, and make more accurate estimated tax payments starting at the beginning of the year. The earlier you plan, the smoother everything operates. Think of this bonus step as a strategic reset. You have a full year of financial data behind you, which makes this the best time to evaluate your entity type. The choices you make now affect your taxes for the entire upcoming year, so use this moment to analyze where your business is heading and whether your current structure is still the right fit. I've linked my other video where I covered this topic in details in the card above and the description below. If you found this helpful, make sure to subscribe so you never miss important tax updates for small businesses. Thank you for watching.